We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
While I'm biased in thinking that choosing a good financial advisor is one of the best decisions you can make, I'm not naive to the fact that choosing the wrong advisor can do more harm than good. Choosing a financial advisor can be a confusing process, especially because different professionals adhere to different standards of client care. And making matters worse, there are a litany of fancy titles and a complete alphabet soup of designations that professionals stick on their business cards. If you're going to hire a professional, the biggest investment you can make is in the time you put into selecting the right person. And that starts by understanding some of the major differences between professionals in the industry. Even when two professionals go by the title advisor, it doesn't necessarily mean they provide the same service or adhere to the same ethical standards. Most people don't realize that financial professionals are held to different standards of care. The fiduciary standard requires an advisor put a client's interest first. Registered investment advisors, or what we refer to in the industry as RIAs, adhere to the fiduciary standard, and they're regulated by the Securities and Exchange Commission, or the SEC, which enforces the rules around what it means to be a fiduciary. The suitability standard does not require advice to be in the client's best interest. The suitability standard only requires a broker to make recommendations that are suitable based on a client's personal situation. This standard is enforced through self-regulatory organizations called the National Association of Securities Dealers and the Financial Industry Regulatory Authority, or FINRA. Brokers or registered representatives are only held to the suitability standard and not the fiduciary standard. While they may call themselves advisors, in reality, they're really salespeople with a vested interest in getting you to buy specific financial products or make certain types of transactions. Imagine you need a new car, but you don't know much about the different options available. You'd probably head to the closest car dealer, and let's just pretend it's a Ford dealership, and the dealer asks you to describe what kind of car you need. Let's say you begin to list features and attributes that are best described as a Toyota Highlander, but you can find some of what you mention in a Ford Explorer too. Under a suitability standard, the Ford dealer could say, "Hey, a Ford Explorer sounds like a good fit, and we have some of those right over here," and never mention that a Toyota Highlander more closely aligns with your needs. The dealer makes the sale and earns a commission, and you have a car that's suitable for your needs, but it isn't necessarily what's best for you. The Ford dealer here has a clear conflict of interest in this situation. The dealer can only sell Fords and will lose the opportunity to earn a commission if the client buys a Toyota Highlander. Under the suitability standard, the dealer can recommend the Ford Explorer, even if that's not necessarily what's best for you. Without a great deal of knowledge about the auto market, you wouldn't know you settled for what was only suitable. Now let's compare that to what happens under a fiduciary standard. If the car dealer acted as a fiduciary, the salesperson would be obligated to say, "It sounds like you're describing a Toyota Highlander. We don't sell those, and in order to get a car that best fits your needs, go down the street to Toyota and ask for a Highlander." The dealer might mention a similar Ford model, but they'd also disclose that the Ford was more expensive and not exactly what you need. In this scenario, you have more information about your options, as well as the dealer's financial incentives before choosing a car. This same thing happens in the financial world. Financial professionals working under the suitability standard can sell you certain investments or insurance products that compensate them over competing options that might be a better fit for you. It's also surprisingly common for financial professionals to have multiple industry affiliations that let them act as a fiduciary in some cases and not in others. This allows the advisor to be a fiduciary in developing a financial plan or an investment allocation, but then act under the suitability standard when implementing the recommendations. This is confusing enough that I think perhaps this is worse than someone only adhering to the suitability standard. These duly registered advisors, it's unfair to expect the average person to know when an advisor is or isn't acting as a fiduciary. Most people using a financial professional have a hard time even conceiving that the recommendations being made are in their best interests. Attorneys and accountants are required to put the interest of their clients first. Medical professionals don't put their own interests before the patient's. Why should financial advice be any different? Many financial advisors always act as a fiduciary. You just need to know how to find them. One way is to use a registered investment advisor, or an RIA, which is required by law to act as a fiduciary at all times. And again, this is someone who's just solely registered as an RIA, not necessarily someone who is duly registered and adheres to different standards at different times. And if you want some additional assurance, some RIAs go the extra mile to be certified by the Center for Fiduciary Excellence, or CFEX, which independently verifies that firms are fulfilling their fiduciary duty to the highest standard. You can check and see if an advisory firm is CFEX certified by visiting the CFEX website, which I'll be sure to link to in the show notes. Finally, you should require your advisor to put their fiduciary commitment in writing. Otherwise, they can't be held accountable. Most fiduciaries put their fiduciary commitment in the client agreement you sign at the beginning of a relationship. And if not, then maybe you should ask your advisor to sign a fiduciary pledge. And I have a sample fiduciary pledge that I can link to in the show notes as well. Another area of confusion for consumers is the wide range of job titles and professional designations that people use to convey their expertise. While a job title might have some relevance to a firm's internal hierarchy, you can start with the assumption that all job titles are a form of marketing. I wouldn't get hung up on whether your advisor's title is wealth manager, planning associate, financial planner, portfolio manager, financial consultant, financial specialist, director, senior vice president, president, principal, partner, and so on. The title doesn't really matter in the context of trying to find the best financial advisor for you. Now, while it's a challenge to understand the services someone will provide based on a title, I actually think that the hundreds of professional designations are perhaps even worse. It's very rare these days to meet a financial professional without some combination of letters after his or her name on a business card or in an email signature. The problem is that not all letter combinations require the same degree of expertise, knowledge, or training. There are 3 designations, though, that I find to be more meaningful credentials in the financial advice industry. All 3 require extensive knowledge, continuing education, and adherence to a strict code of ethics. I'm going to quickly run through these just in alphabetical order because I certainly don't want to be ranking them here because I don't know that one is better than the rest. The first is Certified Financial Planner, CFP. This designation is the most comprehensive designation with regards to financial planning. Certification requires a lengthy education requirement and also requires you sit to pass a 2-day board exam. The curriculum covers general principles of financial planning, education planning, insurance planning, investment planning, tax planning, retirement planning, and estate planning. The CFP board requires you have 3 years of professional experience related to financial planning or 2 years of apprenticeship experience that meets additional requirements. When I see someone with a CFP designation, I know that they've gone through the training to recognize issues that may affect your financial plan in all stages of your life. The second designation is the Certified Public Accountant, or CPA. The CPA designation is focused on taxes and accounting. Before you sit for a CPA exam, candidates are required to have 150 semester hours of relevant courses. And the CPA exam covers auditing and attestation, financial accounting and reporting, regulation, and business environment concepts. In my experience working with financial advisors that are CPAs, I find that the prerequisite coursework and exam prepares a CPA to assist in strategic decision-making for individuals, businesses, and other organizations. The last designation I'd like to highlight is Chartered Financial Analyst, or CFA. Many financial professionals consider the CFA designation to be the most difficult to earn. CFA candidates must pass 3 exams, which the website says each require roughly 300 hours of study. And most recently, these 3 exams had pass rates of 26% for level 1, 29% for level 2, and 39% for level 3. The graduate level curriculum focuses on topics including portfolio management, economics, financial analysis, quantitative methods, and corporate finance. Before using the designation, CFA candidates need 4 years of professional work experience in investment decision-making. Having earned the CFA designation myself, I feel like this is the gold standard for investment certifications, but I would caution against expecting some sort of superior investment performance or anything like that just because someone has a CFA. There really is no evidence of that. But when I see an advisor with the CFA designation, I feel safe assuming that they have a very deep understanding of investing issues. I'll be sure to link to these designations in the show notes if you want to learn more about them. But now that we've addressed the titles and designations you might find in an advisor's email signature or business card, let's address something you generally can't figure out without asking: differences in compensation. The way financial professionals are compensated can naturally impact objectivity. Fee-only advisors are only paid by their clients, which creates an incentive structure with the fewest conflicts of interest. The most common fee-only advisor is paid a percentage fee based on the amount of assets being managed, with that percentage fee decreasing as the account size increases. Other fee-only advisors charge by the hour or set fixed retainer fees for financial planning services. Because a fee-only advisor's compensation is not tied to a specific product or strategy, they can objectively provide advice without being swayed by personal benefits. This makes it easier for fee-only advisors to adhere to a fiduciary standard. At the complete opposite end of the spectrum is a commission-only advisor who earns income on products sold to the customer, such as insurance products and mutual funds. They also can earn income from transactions made or accounts opened for customers. The more activity a customer has, the more a commission-only advisor earns. Remember, a commission-only advisor works for his or her company, not for you. And the recommendations they make can be filled with conflicts. Now, there's one final subtle distinction to note between someone who is fee-only and fee-based. Fee-only, which I described earlier, are advisors that are always acting as fiduciaries, and their compensation is closely aligned with the interests of the client. Fee-based advisors earn some of their revenue from fees paid by their clients, but also earn commissions from selling certain mutual funds, insurance policies, or brokerage products. Fee-based advisors often adhere to suitability rules, which means their financial recommendations may not be in your best interest, and those conflicts of interest are much harder to uncover. Beyond how the firm is compensated, you'll also want to know how the individual advisor is being compensated. Are they salaried, or are they being paid a percentage of revenue that their clients generate? I'd personally argue that working with a salaried advisor further reduces conflict of interest. Someone that's paid a percentage of revenue that their clients create might have an incentive to push you away from options that would prevent you from investing more money with them. For example, they might encourage you to roll your 401k over into an IRA that they can manage, even if the 401k is cheaper. And I actually know an incredibly large number of advisors that do this, so this is something to ask an advisor up front before hiring them. Now that you understand some of the basic differences among financial professionals, the next episode in this series will focus on the process of hiring the right person for you. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.